Coming to volatility, and this is really now high tech, so I will not spend a lot of time just to show you where our interest lies, where our passion lies. If this is beyond what your interest is, then you also might grab a coffee or rebalancing losses. What we like to do sometimes is we short. You know, we have these very fancy artificial instruments of leveraged ETFs. You can buy today 3 times leveraged ETF on basically everything. And you can also buy them inverse. These are then called the 3 times leveraged bear ETFs. Nothing we humans normally would invest in. It's very aggressive stuff, but it has one benefit we just use. They offer you money for nothing, for free. And again, this is very geeky. It needs a lot of study, but there is some percentage you can still tear off, especially if the interests are at 0% and you have some time to study and educate yourself. Here really is some free money. I'm also using that for myself, and I get 1% or 2%, in good months even 2% per month. Where does it come from? Here's a short explanation how these 3 times leveraged ETF work. They borrow and leverage on a daily basis. And as such, they have a daily rebalancing loss. And I'm just showing you this here as a mathematical example. If you take an index like S&P 500, and you would construct an ETF which leverages by 2, and the ETF or the index loses 1% per day, the ETF would then lose 2% per day. At the end of the week, in this example here, the ETF artificially here constructed would be break even. The leveraged version would still be negative because of that row loss example. Again, this is advanced math, maybe have a look into that. But what it means is, when you invest in these leveraged ETF, and I think we had the example before, you permanently lose money at a long enough period. So why the hell should I invest in that? But you shouldn't. But invest in the negative correlated, or in the negative, in the inverse ETF. How is that going? I show you here in a chart again. These are a little bit too tiny and not coming out in the black and white impression, but what I'm showing here is the TLT, which is the 20 years treasury, that line here. The line on top, which is a little bit going more freaky, is the 3 times leveraged version of that. And you can see over this period here of 4 years, it is actually not ending up where it should at 3 times the performance. It's ending up only at around about 130%. The rest is these row loss. If you take now the brother of that, which is the inverse, which is basically saying each time the bonds go up, we take a loss, then you end up with the red line. This ETF is called TMV. Theodore, Marcus, Victor, I don't know how you spell it in the US, but you get it. And this is the one I think somebody mentioned earlier. This is the one who is permanently losing. So if you want to destroy your money in the most effective way, invest in that one. Or opposite, if you want to do money for nothing, then don't invest in it, but short it. And again, highly geeky, sorry if I lost you now, or some of you. But if you invest in the negatively or in the inverse 3 times leveraged ETF, which is TMV, you short that. And I did here a simulation. If you short, you have to pay a commission for the money and also for the guy who sold you this ETF. You get a permanent free ride where you can add a couple of percentages per year to your portfolio.
Can you short in a tax-deferred account?
No.
So what do you do in that case?
In that case, you're basically not able to do that here. So this does not work if you have 401k, IRA, or special purpose vehicles where you do tax deferred. They most probably will not offer you these ETFs, and they will most probably also not allow you to short them. Yeah. What you can then do is on a normal saving account with a bank which allows you to short, then you can do that.
So you short funds that you have outside of those accounts to compensate for what you have in those accounts. Exactly.
Again, you're shorting, which means you don't need money for that. It's basically anti-material, if you want. It's negative. It's negative money.
When you short, how long do you do a rebalance?
Pardon me?
When you short, do you do a rebalance?
Yes. In that example here, again, we're talking about 3 times leverage, so this is not monthly time period. You most probably have to watch that at least on a weekly level.
Okay.
Yeah. Yeah. So again, just to show you how this works here, that it works, over that period here from 2009 to 2015, shorting that, you would have made a 4.4% annual return without needing any money, because you short and you balance that with your active part of your portfolio. And in a very constant way, because you don't depend on the market. Yeah, you short it and you balance that within a long part of your portfolio.
If there's a fresh crash during the when you short, will you lose though? Will you get a margin call during that period?
And again, you won't do that with 100% of your savings or retirement account. You will do that opportunistically when the borrowing cost is low and these ETF are available. It's just one of the options we make available to our investors. If you normally invest in TLT, many of our strategies invest in TLT or EDV, we will tell you, for example, hey, right now the borrowing cost, we use Interactive Broker as an example, is very low. Yeah. The rolling cost is very high because the markets are going up. Yeah, it's a good moment, for example, to swap instead of going long TLT. Yeah, try to get some short TMV. Yeah, and do that as long as, again, borrowing costs are low and there is this roll loss effect.
I couldn't understand what the question was.
Yeah, because of the fresh crash, you can go either way. When you short the bond, you can lose 90%. Then you get margin call and you account got wiped out. So I'm just worried about it.
Okay, then maybe let me catch you from there. Imagine you invested in a strategy which said we go 60% SPY S&P 500 and we go 40% into bonds. Okay, so you would, just as an example, invest $50,000 into bonds. Okay, now take these 50,000 and you don't go long bonds, but you say I invest these 50,000 short into TMV. Yeah, and again, it's a 40% of one strategy, which most probably is 20% of your overall portfolio. So it's a relatively small percent of your capital. And yes, we rebalance frequently, so most probably after a month you would be out there. I just brought this example here to show you, yes, there are possibilities to make free money. Yeah, these are rare. It takes a lot of education, but you can do that here, as I just wanted to show you in this example.
How easy is it to get these shorts and when during
Yes. I just looked it up. April 5. Here's the link also where you can look that up. How many of these are available? Because these, for example, there are only 100,000, for example, available. And also what the borrowing cost is. There's a link, and again on our website, we discuss it much more in detail also.
So you physically shorted and then played through options?
No, we short the ETF, yes. How you can benefit from that? Again, we do that, or we explain people more in detail how to do that as an option in several of these strategies. It's not a normal course. It's way too complicated for 90% of our people also. If you have some free time and want to have a little bit more return on your portfolio, this is one of the ways I do by myself, for example.
Is buying a put in your tax-deferred accounts a viable strategy for this?
No. Again, tax-deferred account, most probably no way to do this.
You can buy a put. You can buy puts. You can buy.
It really depends on what tax-deferred account you have, which broker, what possibility is in there.
Most brokers will allow you to buy options within your tax-deferred accounts. Not your 401ks, but most brokers will.
Again, it might be. And also, sorry, I'm not US citizen, so I have no 401k. I just know by reference from others. And I also, for those few of you who might be interested in this geeky stuff, there are some other readings you might have. We have written long articles about that. And here's the second geeky part. Because we're talking about volatility, and we're talking about here volatility ETFs. The most famous of it is, or you know the index is VIX, VIX. And here two fancy words you can scare other people off and make yourself more appealing. One is called contango and the other one is called backwardation. And the way how I memorize that is I just imagine the mood of my wife. Whenever the mood of my wife is good and going up, I'm just in the mood of dancing some tango with her. This is the future term curve going up, contango. If my wife's mood is not that good, I'm rather in backwards mood. And this is then called backwardation. I hope you got it. And it's really that easy. I gave you here a link, an excellent site with a lot of stuff. This is basically now the Wikipedia for all the volatility freaks here. VIXcentral.com. It's on your slides, have a look there. They show you these curves, current, historically, whatever you want. And it's that easy if the volatility futures, for example, in 2 or 3 months, are higher than the current volatility level or the first month future, then we are in a contango mood. And this pretty much has been since the case since we left the crisis 2009 to 2015. But in the crisis, for example, and this year is October 2008, the VIX, the volatility level was at 80% or so, but people had an expectation that the volatility would go down in the next couple of months. So buying volatility ETF with 3-month duration or 6-month duration was cheaper than the volatility level at the immediate term. And that's then backwardation. And there's a way how you can play with that and use it as a hedge mechanism and also as a return driver. Again, here's some geeky stuff, which I will just jump over, but how to calculate the percentages and how to understand that better. how the contango is determined based on the futures. Just keep in mind here, in the next slides, I'm always going to talk about this thing here, SIV, Z-I-V. And this is the velocity shares daily inverse VIX midterm, which means we are looking at 4 months to 7 months in the future. Why we use that, and again, by backtesting, by checking out, we have found that this is the most stable instrument to use it in the way we are using that here. This contango between month 4 and 7 in the last couple of years is the black line. And you can see this has been constantly positive, and it has been mostly in a range between 0 and 10%. Which again means if you invest in this ETF and things stay as they are right now, we are in a contango mode, you make permanently money with that. You have a monthly 1%, 0 point something percent, which you get basically for free. Again, I'm not a get rich now guy, but there are some mechanisms which really the pros and the hedge funds are using, and this is one of the mechanisms you really can make some money if you understand it, if you know, educate yourself. Then contango and volatility fear premium is an excellent thing. Why does that work? Because normally people use volatility to hedge. Yeah? Wow, S&P 500 is in record high. My fear is that I'm going to lose money, it's going to tank. So what do? You protect yourself by buying puts, options, or futures. And normally if you do that and you try to protect yourself, somebody is going to ask for a lot of money to give you that protection. And this is why these volatility curves are normally convex, they're going higher. The longer term you want protection, the more it's going to cost you. Yeah, because of the underlying uncertainty. And Black and Scholes and the other guys. And this is why this mechanism works. Normally protecting yourself over 6 months is more expensive than protecting you for 1 month. Yeah? And as long as these simple things work, high S&P plus fear premium, then you just flip-flop it and make money out of that. And this is my summary chart, and then we end this geeky session here. But again, what normally is a cost for people to protect their portfolio from these sharp corrections, for ourselves can become an income, a very stable income, when you buy the inverse volatility ETF. And our amigo here is SIV, Z-I-V. Why? Because it's just more stable.
Pardon me. Back on the previous slide. Yeah. Which is the dark line? I don't see it.
Okay, again, sorry. The more volatile is the one we don't like. The more stable. Hard to describe. Yeah.
Which is it?
The black one. Month 4 to 7. Yeah.
Oh, okay. I see now. All right, thank you.
Sorry, I didn't know that you had black and white handout. So, but you see that also better in that chart here. You can see here, this is from 2011, since the inception date of this SIV. This is constantly going up. Yeah. With some corrections, and these are recently, yeah. But again, this is part of the advanced options of our strategies, where we would tell you In the maximum yield, for example, we employ that. Yeah. This month we go EDV 60%, 40% into SIF. Depending on how the markets develop, we will scale that down or scale that up. And here again, some advanced readings, and where we employ that. Yeah, so this is not only geeky, it's really working in practice, and we have been doing that the last couple of years. And getting some free money is always good.
I assume that the link are on your website, Logical Invest?
Yes.
Okay, thank you.
Yes. Yeah. I also obviously going to share you my email if there's any question, or the geeks among the crowd here, just send me an email.
Excuse me. Do you consider the impact of capital gains taxes when you sell a position?
Okay. All our strategies and how we publish and test them is gross of tax. So tax impact not included. Why? Because the individual tax situation of everybody changes, so we cannot show you that. But this is gross tax. Yeah.
So what metrics do you use when you're building your models? You talked about sharp optimization, but do you use Sortino or maximum drawdown, or what are the different metrics that you use?
All of them.
You use all of them?
And I come to that in the next part, actually.
Oh, thank you. Automated investing, the two strategies?
Automated to the sense of these strategies run on our server. We are not touching them, and they tell us what to do. Semi-automated, because then it's up to us or up to you to go to your broker and rebalance your account. Yeah?
How often do you turn over your portfolio of these strategies?
Normally all our strategies are monthly.
Every month you take a look, see what those signals are, and then buy.
Yes, yes, and I show you how this works on our side also if you're interested.
Okay, I understand your approach here, but the pros already have these automatic training buy-sell mechanisms in place.
Yeah.
If we're doing this, or you're doing this,
Yeah.
once a month,
Yeah.
you're always behind the power curve because everybody else is moving ahead of you in real time, whereas there's a 1 month lag here associated with execution using your strategy recommendations. So it's like you're already at a disadvantage.
Yes and no. First of all, yes, many of the hedge funds, they use mechanisms like that. Yeah. So again, this is stuff they would sell you. But I think with some education, we can do that by our own. Second part of it is no. It depends on how, for example, the parameters. We look back 63 days, or we look back 27 days. The hedge fund has a different mechanism, so not everybody is exactly doing the same thing in a synchronized way. If that would be true, then yes, indeed, the big guys would permanently
Corner the market.
Exactly. Yeah, but that's not true because it happens at different times.
Okay.
Yeah, and these are huge markets. The volatility market is huge.
Yeah, no, I get it, but I'm just looking at the fact that they've got computers sitting in a room doing this stuff on automatic, real-time scenarios.
It's not. Again, this is not a nanosecond algorithm.
No, I get it.
Yeah. If that would be true, then yes, they would be faster.
Most of the strategies, and I love algorithms because of their predictability, but they are indeed based on the past. And
Correct.
the question is, yes, we're doing diversity, we're looking at different strategies, and we're trying to optimize the strategies. One of my questions would be, as you go along with the different strategies and market conditions do change, how do you adjust your algorithms, or how do you take this into account?
Mm-hmm. Excellent question, and one of the questions I most like, because it gives me a little bit opportunity also to what are we doing differently? For example, yes, we work with well-established mechanisms, but we do not try to backtest them since 1929 Great Depression. Yeah, we are a little bit more opportunistic than many of the well-established big banks and financial advisor would tell you. If a mechanism worked in the last 80, 90 years, yeah, it does first of all is not proof enough to show you that it will work in the future. And secondly, it's in our eyes too stable, too average, let's say. Yeah, some of the mechanisms which we think will always work is basic trend following, momentum, mean reversion, certain of the other elements we have shown here. But for example, we sometimes get a request, hey, could you show me a backtest of that? How did it work since the 70s? Technically, I could do that. It cost me an hour, 2 hours to do the backtest. But my question is, what would it show me? For example, this thing I just showed you with the volatility, this is an effect and a mechanism which started being effective since 2010, 2011. Before that, nobody, at least in the retail sector, was investing in these volatility ETF. So that mechanism would just not have worked. So back to your questions, we're a little bit more opportunistic here. If we detect a mechanism which starts working, then we hop on it. Yeah, and we adapt our strategies to it. Which sometimes brings us the criticism that we are curve fitting the past. Which is not true. We're just trying to be a little bit more adaptive to the changes in the market. So we have introduced for some of the more the bigger strategies I will show you, we have implemented already the second version now. We're fine-tuning it and adapting it. Yeah, which again, you didn't take it from two sides. You could say, Alex, you're just making up the past, the way it looks fancier, or I think this was your argument, you can say, we adapt to how the market conditions are.
So to follow on with her question, what period of backtesting do you use as an example? In Fred Piard's book, he uses portfolio 1, 2, 3,
yeah,
which goes back about 15 years.
Yeah.
Now, he will look at 3 different 5-year segments and then try to determine if the strategy is more all-weather or not. Now, it looks like you're looking at you're weighting more heavily the more recent past.
For example, the bond rotation, which I think is also critical to see a longer period, we have backtested more than 20 years using mutual funds. Yeah, universal investment, you can backtest, it's S&P and TLT, you can backtest since the 50s if you want. Yeah, so that's not a problem. The long period, it's very often giving you a false accuracy. It's giving you a false sense of being relaxed. Yeah, which I'm a little bit cautious sometimes.
So let me try one more time then. It sounds like you have a number of different strategies that have been back-tested for a long period of time.
Yes.
And you're using some pair switching timer to switch between
yes.
the pairs. What period of time do you look at your momentum decisions?
Do me a favor, let me show you first the strategies and how they fit together into the portfolio, and then we dive into a little bit more the technicalities, look back, and how the backtest work. Is that fine?